Welcome to the second podcast of Text Concept. In today's podcast, we shall cover specific issues of taxation of virtual digital assets, such as under which head of income the gains from VDAs will be taxed. Is it capital gains, profit and gains from business, or income from other sources? And more importantly, does the classification of heads of income matters to you? Secondly, when and how does the transfer of VDAs take place? What happens if you transfer VDAs without consideration? Do you have to pay tax on the notional gain from such transfer? How is notional value of VDAs is to be determined? Thirdly, what happens if I lend my VDAs and earn interest in form of additional allocation of VDAs to me? Can I claim depreciation on such VDAs that I have lent to earn interest? What are the elements of cost that are included in the cost of acquisition of VDAs? Is indexation of cost of acquisition allowed? Can I add the cost of mining of Bitcoins in the cost of acquisition? What is the relevance of the phrase, if any, that the legislature has added to the cost of acquisition? Also, can I claim losses on my transaction in VDAs? Is there any scope of setting off of losses that I unfortunately made prior to 1st of April 2022? And many more intriguing issues of taxation of VDAs. Before we deal with these specifics, I want to discuss two developments around the VDAs in the last fortnight that are of interest to us. First is the apprehension expressed by the finance minister on transactions in VDAs in her meeting with the chief of the International Monetary Fund. Two elements of FM's anxiety are particularly noteworthy. First is a mistrust of some of the actors dealing with the VDAs and the purpose for which such transactions may be used. She expressed a fear that if VDAs are not closely monitored and supervised, then disruptive elements like the terror organization may use receipts from VDAs to fund their activities against the states and the nation. Now, this is a clear indication that transactions in VDAs are likely to be closely watched by government agencies and the international organizations now and in the future. So my repeat advice to you is that please disclose all VDA transactions in your tax returns. Otherwise, you will definitely run foul of tax authorities, if not now, then in the immediate future. The government agencies would decipher any hidden or camouflage software that any secretive VDA exchange may promise you. It may not happen today, but it will happen tomorrow. Second element of FM's interaction with IMF is the reiteration of Indian government stand. Taxation of VDAs do not make transaction in VDAs legal or above board. Taxation and legality are two separate issues, and their relationship is complex. In the famous case of CIT versus Pyara Singh, the Supreme Court, as far back as 1980, allowed the expenses of confiscation of currency notes of a smuggler by the custom authorities. The court held that if smuggling was a business to be taxed, then the confiscation of currency notes was a loss occasioned in pursuit of such business and which sprang directly from the carrying on of the business and was incidental to it. To overcome such controversy, legislature in its wisdom introduced explanation to subsection 1 of section 37 of by the Finance Act 1998. And they did it with retrospective effect from April 1, 1962. The explanation reads as follows, and I read, "For the removal of doubts, it is hereby declared that any expenditure incurred by the assessee for any purpose which is an offense or which is prohibited by law shall not be deemed to have been incurred for the purpose of business or profession, and no deduction or allowance shall be made in respect of such expenditure. Unquote. My short point is that do not get taken in by taxation of gains from VDAs to presume that dealing with all VDAs is a legal activity. You may have been taxed on some VDA gains, and yet you may face action under other laws for dealing with those exchanges of VDAs that operate in gray area and in violation of the laws of the land. A pointer for the gender equality aficionados to feel happier. Both the FM of India and the IMF chief happen to be learned ladies. Madam Nirmala Sitharaman, the FM of India, is a well-known name, and the IMF chief is Kristalina Georgieva, an outstanding economist from Bulgaria. The second development that I want to draw your attention is that a very vocal supporter of digital currencies and VDAs, particularly the Dogecoin, Elon Musk has become the sole proprietor of Twitter. And as you all know, Twitter is perhaps the most influential opinion platform in the world. So expect VDAs to become more of an impassioned discussion point in very near future. Now let's deal with our specific questions. How do we classify VDAs in the typology of heads of income? The income arising from transfer of VDAs can be profit and gains from business. It may be capital gains, or it sometimes would be income from other sources. When you hold VDAs for the sale in the ordinary course of business as trading assets, then the profits arising would be taxed under the head profit and gains from business or profession. This would clearly apply to the traders of the cryptocurrencies. Whereas if VDAs are held as capital assets, the income shall be taxed under the head capital gains. When is an asset a capital asset as opposed to a trading asset? This is an intriguing issue that has led to a lot of litigation, especially in the cases of shares and securities. The critical factor is the intent of the holder of the VDAs. Do I hold them as investment or treat them as an everyday commodity that I often buy and sell? And this intent, motive, or purpose is to be derived from the facts and circumstances as well as the surrounding circumstances, like how often I trade in VDAs. Do I hold only one type of VDA, say Dogecoin, or do I also deal in number of VDAs such as Bitcoin or Ethereum or the other NFTs? How long do I hold particular VDA will also be a factor. To reduce litigation and maintain consistency in approach, the CBDT has issued two important circulars prescribing the principles to classify shares or securities as capital assets or trading assets. These circulars are listed at circular number 4, dated 15th of June 2017, and circular number 6, dated 29th of February 2016. However, my favorite reading on this topic are two judgments in the case of H. Locke Larsen, and I would recommend you to read these. The clarity of thought and articulation of language of Justice Chandrachud while delivering the judgment for Bombay High Court in 1971, and of Justice Sabyasachi Mukherjee in delivering the Supreme Court judgment in the same case in 1986 are worth admiring and learning. They bring clarity on the concepts and parameters you need to consider to decide when an asset is an investment and how and when it becomes a stock in trade. Though the circulars and judgments are applicable in the case of shares and securities, I strongly believe that the same principles prescribed therein are ipso facto applicable to classify VDAs as a capital asset or a trading asset. I cannot help but make a tangential point here. Notice the time gap in two judgments. It is 15 years. Here is a learning point for both taxpayers and tax administrators. Let's reduce litigation, particularly the frivolous disputes. It has huge financial, economic, and psychological costs for the taxpayers as well as for the nation. The core issue is, does it matter whether VDAs in my hand are classified as assets or stock in trade or taxed as income from other sources when gains from VDAs are taxed at a flat rate of 30%? The answer is yes, it matters. Though the tax rates are the same 30%, whether the income is taxed under the head income from business or profession or capital gain or other sources, but the classification of head of income is essential for computation of interest under section 234C of the Act. If a shortfall in payment of advance tax happen on account of underestimation or failure to estimate the accrual of a capital gains, then such shortfall is ignored while computing interest under section 234C of the Act. But if your gains from VDAs are taxed under the head profit and gains from trade or business, then you are liable for interest liability under section 234C of the Act. Classification of head of income matters in another way also. What happens when a VDA is lost or stolen? It is possible that virtual digital asset may be lost or stolen. Cryptocurrencies are often lost when a private key is misplaced or forgotten, or an inheritor cannot access the wallet. Many such instances of loss and theft have been reported in reputed journals like the Wall Street Journal. Now, the Supreme Court has held in the case of Vania Silk Mills Private Limited, and the case was reported in 1991 in 59 Taxmann 3, that there is no transfer when the asset is destroyed, as the asset must exist in the process of transfer. Thus, the definition of transfer does not apply in case the VDA is stolen or misplaced, and accordingly, the taxability in such cases may be governed by the general provisions of the Act and not the section 115 BBH of the Act. If the VDAs have been treated as a capital asset, no capital loss shall be allowed to the owners. However, if VDAs have been treated as stock in trade, any loss due to such an event ought to be allowed under section 29 of the Act. The trading loss of a business is deductible under section 29 of the Act for computing the profits earned by the business, but every loss is not so deductible unless it is incurred in carrying out the operations of the business and it is incidental to those operations. A business loss shall be allowed provided it is revenue in nature, it is incurred in the relevant previous year, loss is incidental to the actual profit carried on by the assessee, and the loss is not fictional or expected in future. And finally, there is no provision, direct or indirect, in the Income Tax Act restricting such deduction. So the short point here is that you may be permitted loss on account of a stolen cryptocurrency if you are taxed under the head income from profits or gains from a profession, and not if the VDAs are taxed under the head capital gains. Now let's discuss the issue of transfer of VDAs. The income from VDA is taxable only if it arises on the transfer of the VDA. The word transfer is defined under section 247 of the Act in relation to capital assets. Now, a VDA can be held as a stock in trade or as a capital asset. Can we argue that tax on gains would apply only in case of transfer of VDAs held as a capital asset? To avoid any dispute, subsection 3 of section 115 BBH provides the definition of transfer shall apply to any VDA whether it is a capital asset or not. When we analyze the definition of transfer under section 247, we find it has been defined in an inclusive manner. Inclusive definition in law implies that the term shall be deemed to include all transactions prescribed in section as well as what constitutes a transfer in the common parlance. So the definition of transfer is broad and includes all those transactions that may be considered as a transfer by a common man. It can be a transfer by way of sale or transfer by way of exchange. It may be transfer by way of relinquishment or extinguishment of rights. Compulsory acquisition is a transfer too, and so is transfer by way of conversion into stock in trade. It is important to remember that three typologies of transactions are statutorily excluded from definition of transfer. The first is that lending of VDAs is not a transfer. Second is any distribution of VDAs in kind by a company to its shareholders at the time of liquidation is not to be treated as a transfer of an asset by the company, but the shareholders are liable to pay tax if any capital gain arises under section 46 of the Act. Thirdly, transfer of VDAs through a gift, a will, partition of HUF, or business restructuring as per section 47 of the Act are also not transfer of VDAs. An interesting implication of the definition of transfer arises when VDAs are exchanged. All crypto exchanges allow buyers to buy a cryptocurrency in exchange for another cryptocurrency. For example, Mr. Singh buys 20 bitcoins from Mr. Kumar in exchange for 100 Ethereums. In this case, there is a transfer of VDA from both sides. Transfer of Bitcoin by Mr. Singh and transfer of Ethereum by Mr. Kumar. Accordingly, tax liability would arise in the hands of both Mr. Singh as well as Mr. Kumar. Another interesting instance is where a cryptocurrency is acquired by Mr. Kumar for investment, but he subsequently converts it into stock in trade of a business carried on by him. It shall be deemed that the capital asset is transferred during the previous year in which such conversion takes place, and the capital gain is to be computed in the same year. It is worth noting, though, that the capital gain so computed in the year of conversion shall be charged to tax in the year in which stock in trade is ultimately sold or otherwise transferred by Shri Kumar. Thus, two types of income shall be charged to tax in the year in which stock in trade is sold. First, the capital gain so computed on the date of conversion under the heads capital gains, and second, the business income arising on the sale of stock under the head profit and gains of business or profession. A taxable event will also happen when the reverse takes place. If the VDAs held as inventory of a business are converted into capital assets, its fair market value as on the date of its conversion shall be taxable as business income under section 28 of the Act. The problem is that section 115 BBH neither provides the method of computation of fair market value, nor it gives any power to CBDT to prescribe it, unlike section 50CA or section 50B of the Act. There are practical difficulties in determining the market value of cryptocurrencies due to high fluctuations in value, and exchange platforms may have different prices for the same cryptocurrency at any point of time. For example, it has been reported that the price of the Bitcoin on the 9th of February of 2022 at 4:55 p.m. was valued anywhere between rupees 32 to rupees 34 lakhs. I suggest that CBDT ought to be empowered to provide the rules for computation of fair market value in case of transfer of VDAs. However, in the absence of any guidance, The fair market value can be determined based on the price at which it is listed on an exchange platform on a date of exchange or transfer. In the case of an over the counter deal or barter transaction, the taxpayer may take the lowest value among all the exchange platforms. This is prescribed method in context of valuation of shares or securities under Rule 11 UA, but principle on the same lines can be applied for valuation of VDAs in absence of any specific guidance in the Act or the rules. Most exchanges also allow the investor to lend their holdings of cryptocurrencies to earn interest. Such lending of cryptocurrencies cannot be termed as transfer, as the title of the asset is not transferred to the borrower. The amount of interest earned by the investor from such lending is normally credited in the same cryptocurrency that he has lent. Such interest income ought to be taxed under the head of income from other sources or business, but the tax rate applicable shall not be the rate which is specified under section 115 BBH. A related query is that can a person engaged in lending of VDAs claim depreciation and treat it as an intangible asset? Section 32 allows depreciation in respect of intangible assets such as know-how, patents, copyrights, trademarks, licenses, franchises, or other business or commercial rights of similar nature. Here, the meaning of the expression any other business or commercial rights of similar nature has been explained by various courts to mean those business or commercial rights which are either akin to know-how, patents, copyrights, and trademarks, or fall within the same genesis or genre. As the VDA is neither akin to know-how, patent, or copyright, nor it falls within the same genre of assets, it cannot be treated as an intangible asset for the purposes of depreciation under Section 32 of the Act. Let's try and understand the concept of the cost of acquisition of VDAs. Section 115 BBH2A provides that no deduction in respect of any expenditure or allowance or setup of any loss shall be allowed other than the cost of acquisition in computing the income on transfer from VDAs. It implies that expenditure incurred in connection with transfer of a virtual digital asset shall be ignored. Cost of improvement relating to a virtual digital asset cannot be allowed. No exemption is available under Section 54F of the Act. As we already discussed, no allowance of depreciation or other expenses can be allowed. One important issue is whether indexation of cost of acquisition is allowed in computing the income from VDAs. Section 115 BBH2 starts with notwithstanding anything contained in any other provision of this Act. This clause will override all other provisions of the Act, including the second proviso to Section 48. In spite of the fact that there is no specific prohibition on indexation of the cost of acquisition of VDAs under Section 115 BBH or Section 48, my opinion is that indexed cost of acquisition would not be allowed in computing the long-term capital gains from the transfer of VDAs. Now, let's examine what is the relevance of the words, if any, inserted by the legislature after the cost of acquisition. While computing the income from the transfer of VDAs, an assessee is allowed to claim the deduction of only the cost of acquisition. There may be situations where the cost of acquisition of VDA is nil or otherwise cannot be determined or ascertained. For example, the new VDAs are launched and airdropped to an influencer. On the said date, as the VDAs are not listed on any exchange, the value would be nil or indeterminable. In a seminal judgment in the case of CIT versus BC Srinivasa Shetty, which is reported in 1981 at 5 Taxmann number 1, Supreme Court has held that if there is no cost of acquisition of any capital asset, then computation provision fail and therefore no capital gains can be computed. To avoid any controversy in case of VDAs, the word if any has been inserted after the cost of acquisition. It implies that income from transfer of VDAs shall be computed as per section 115 BBH even if the cost of acquisition is nil or not available. Now, let's consider some elements in the methods of computation of cost of acquisition. For computation of capital gains, a capital asset is normally bifurcated into short-term and long-term. This distinction is not important to compute the capital gains or business income from transfer of VDAs, as the incidence of tax is the same in every situation. Now, if a person is regularly selling and buying VDAs, it is essential for him to identify the cost of acquisition of VDAs being sold. Section 115 BBH does not provide any guidance on how such correlation should be made. Either he can follow the first in, first out method or weighted average method to compute the cost of acquisition of a VDA that has been sold. Circular number 768 of 1998, issued by the CBDT, provides that the FIFO method should be used to determine the price of holding of securities held in demat form. In absence of guidance in section 115 BBH or similar clarification from the CBDT on transfer of VDAs, the investor might take the position to use either the FIFO method or the weighted average method, whichever is more beneficial to him. Let's also examine an interesting issue. Can the cost of mining be included in the cost of acquisition? To mine a cryptocurrency, a person invests in computers and mining machinery and incurs huge electricity charges. Whether such capital expenditure and electricity charges may be considered the cost of acquisition of a mined cryptocurrency. In other words, can the cost of creating a capital asset be considered its cost of acquisition? The word acquisition is of wide amplitude, much wider than the word purchase. A purchase is one of the modes of acquisition, and a property can be acquired even otherwise than by purchase. The decision of the Gujarat High Court in CIT versus Mohan Bhai, Pama Bhai, reported at 91 ITR 393 and affirmed by the Honorable Supreme Court 14 years later at 165 ITR 166 may offer useful guidance to the meaning of the word acquisition of a capital asset. The court held as under, and I quote, the word acquire, according to its plain natural meaning, is a word of wide import. It is not confined to obtaining of a thing from a third party. There are various modes of acquisition by which a thing may be acquired by a taxpayer, and creation is one of them. Unquote. Relying upon this judgment, it may be claimed that when a cryptocurrency is created, it is deemed to be acquired. Therefore, all expenditure incurred during the creation process should be considered the cost of acquisition unless Section 55 of the Act explicitly disallows such costs of creation. The Income Tax Act is silent on method of computation of cost of acquisition of a VDA generated during the mining process. In absence of such guidance, the revenue expenditure specific to mining operation could be added to the full cost of acquisition, and capital expenditure specified to mining operation may be added to the cost of acquisition in a proportion of the asset mined during the year to the total mining capacity. All other capital and revenue expenditure not specific to mining operation but attributable to general operation would not be allowed. Let me point out, this issue is not free from doubt and it is likely to generate huge litigation. I would suggest that CBDT may bring out a clarificatory circular on this issue. The next issue is the treatment of loss on transfer of VDAs. Subsection 2 of Section 115 BBH contains two clauses. Clause A provides that no set-off of any loss shall be allowed to the assessee in computing the income referred to in Section 115 BBH1. And Clause B provides that no set-off of loss from transfer of VDAs computed under Section 115 BBH1 shall be allowed against income computed under any provision of this Act, and such loss shall not be allowed to be carried forward to succeeding assessment year. Both clauses are an attempt to ring-fence the losses arising from the transfer of VDAs. It neither allows any loss to be set off against income from VDAs, nor allows loss from VDAs to set off against income computed under any other provision of this Act. The expression used in Clause B is any provision of this Act. Thus, it shall include even income computed under Section 115 BBH itself, which is the income from transfer of VDAs. In simple words, any loss arising from the transfer of VDAs would be a dead loss, and it will not be allowed to be adjusted, even against income arising from transfer of other VDAs, whether of the same category or not. But an interesting issue is what happens to the losses incurred on or before assessment year 22-23. Section 115 BBH2 prohibits carrying forward of and setting off of losses from VDAs with effect from assessment year 23-24. Would such provision impact the losses incurred on or before the assessment year 22-23? In other words, can such losses be carried forward and set off with income taxable under the relevant head, except income from transfer of VDAs in the assessment year 23-24 and onwards? A similar issue was dealt by the Supreme Court in the case of CIT versus Shah, Sadiq and Sons in 1987 at 31 Taxmann 498. The Apex Court held that under the 1922 Act, the assessee was entitled to carry forward the losses of speculation business and set off such losses against profit made from that business in future year. The right of carry forward and set off accrued to the taxpayer under the 1922 Act. A right that had accrued and had become vested continued to be capable of being enforced, notwithstanding the repeal of the statute under which that right accrued, unless the repealing statute took away such right expressly. My opinion is that taxpayer has a right to carry forward and set off the losses incurred on transfer of VDAs on or before 1st April 2022. Such losses shall not be allowed to set off against income taxable under Section 115 BBH, but such rights can be exercised within the four corners of the provisions specified in Section 72, Section 73, and Section 74, read with Section 80 of the Income Tax Act. Is VDA a property, and does it attract tax for receipt without adequate consideration? The Finance Act 2022 inserted virtual digital assets in the meaning of property in explanation D to Section 56(2)(7) of the Act. VDAs are as much a property as the shares in securities or bullion. If a person receives a virtual digital asset without consideration and for inadequate consideration, in simple words, he receives a gift of VDAs and the value of such gift exceeds rupees 50,000, then it shall be taxable in the hands of the recipient under section 56 to 10 as the income from other sources. It is to be noted, though, that the property defined under explanation D to section 56 to 7 should be capital assets of the assessee. Thus, to become a gift, the VDAs in question must constitute capital assets in the hands of the recipients. There are exceptions to this. No deemed income shall arise if the VDAs are received in the circumstances that are enumerated in proviso to section 56 to 10. And these are: no gift shall be deemed to accrue on the occasion of marriage of the individual, or if the VDAs are received under a will or by way of inheritance, or they are received from specified relatives which are again listed and enumerated in the Act. The value of the benefits arising under section 56 to 10 will be taxed at the rates applicable to the taxpayer. Such income shall not be taxed at 30% under section 115 BBH because it does not arise due to transfer of a VDA. However, when the recipient further transfers such assets, the resultant gain shall be taxable under section 115 BBH. Number of other issues also arise in taxation of VDAs. I have selected those which, in my opinion, are significant and are also open to some confusion and some discussion. The foundation of VDAs is the transactional trust and a belief in the fairness and equality of all the participants in the financial transactions. The core principles of VDAs and their long-term management is very well articulated in the definition of distributed ledger technology by the World Bank. I end by quoting that definition and in the hope that transactions in VDAs shall be carried out in spirit of collective maintenance, and control of VDAs will remain in a distributed network of participants who have a right to impose costs on a defaulter of mutuality and trust. And I quote the World Bank, which defines the distributed ledger technology as a novel and fast evolving approach to recording and sharing data across multiple data stores called ledgers, which each have the exact same data records and are collectively maintained and controlled by a distributed network of computer servers, which are called the nodes. In the end, I also recommend a wonderful book written by a professor at the Cornell University. It is a scholarly research on future of money and digital currencies, and it is written in simple and clear language that resonates with a layman reader. The book is published by Harvard University Press in 2021, and the title is The Future of Money: How the Digital Revolution is Transforming Currencies and Finance. Happy reading, and I hope you explore this emerging development of fintech with curiosity of a discoverer and maturity of a responsible citizen. Thank you till we meet again after a fortnight.